Let's separate confidence, which is a big deal, and stimulus, which is also what I was talking about in the caption you read. As far as China's concerned, yeah, China's a house of cards. It's going to collapse. It's going to be ugly. Hard to say when, but probably sooner than later. And they know it. And they're not going to be a global reserve currency. So we can put China to one side. But yeah, China's a house of cards. Now, getting it back to the United States. So the first point, let's talk about stimulus first. So yeah, the Fed printed $4 trillion. We had $1 trillion, what are called baseline budget deficits going into the pandemic. So with no pandemic, we were going to have $1 trillion deficit in 2020 and 2021. Now, Congress put $3 trillion on top of that with rescue and bailout programs last March, April, and May. That was the CARES program, payroll protection plan, aid to hospitals, extended unemployment benefits, higher unemployment benefits, et cetera. I'm not saying any of those things were bad. It was needed to keep things from getting a lot worse. But we put $3 trillion on top of this. So there's $4 trillion for fiscal 2020. They just did $1 trillion last week in the kind of final days of the Trump administration. So that's $5 trillion. And Biden has announced his plan. He's going to have a $2 trillion rescue bailout, so-called stimulus plan now. So that's $7 trillion plus the $1 trillion baseline for fiscal 2021. So there's $8 trillion in deficit spending in 2 fiscal years, $4 trillion of money printing by the Fed. Now, those are the numbers. That's not projections. That's baked in the pie. Just don't call it stimulus. It will have no stimulative effect. Does it, again, as I say, keep the lights on? Yes. Would some people keep their jobs last spring because their employer got payroll protection plans? Yes. Did other people benefit from increased unemployment benefits? Yes. Was a lot of that necessary because things were in such bad shape? Yes. So I'm not arguing that side of it, but it does not stimulate. It's not going to get us out of the depression. Let me be very specific as to why, because I don't make claims without backing it up. On the money supply, you can print all the money you want. But Milton Friedman was wrong. The monetarists are wrong. The Austrian school is wrong. Money printing does not cause inflation. What causes inflation is something called velocity, which is the turnover of money. The money has to be lent and spent. Banks have to be lenders. People and businesses have to be borrowers. You have to be spending it, get it in circulation, in other words, in order potentially to have some inflation. And that's the technical name for that is velocity. Velocity is dropping, sinking like a stone. By the way, it's been dropping since 1998. It dropped faster in the 2008 crisis. It's dropping faster today, but the trend has been very steeply down for the last 22 years. And so, nominal GDP, so the dollar value of all goods and services, leaving aside inflation, that's what we mean by nominal value. Nominal value of gross domestic product is money supply times velocity. How much money is there and how much does it turn over? Multiply one by the other, and that's your nominal GDP. And I remind people that $7 trillion times zero is zero. Meaning you can print the $7 trillion, but if you don't have any velocity, you don't have an economy. And so you can understand monetary policy is a desperate race between increasing money supply and declining velocity. One offsets the other so that you barely keep nominal GDP where it is. In fact, it's going to go down about 6 or 7% for 2020. We don't have those numbers yet. We're not getting back to 2019 levels of output. If you take 2019 as your baseline and then down in 2020, we're not getting back to 2019 levels till 2023 at the earliest. We're not getting back to 2019 levels of job creation, the number of people who have jobs, until 2025 at the earliest. That's why I call it a depression, not a recession. Now flip over to fiscal policies. Like, hey, they're sending everybody $2,000 checks, and they are. The people are going to get those checks. And so the Wall Street, which usually gets things wrong. That's the first thing you got to know about Wall Street, because they don't really care about you. They care about rap fees and how they make money. So they're saying, all right, they're going to send out the $2,000 checks, and people are going to get those checks, and they're going to run right out, and they're going to buy a car, a refrigerator, paint the kitchen, whatever it may be. No, the first two things are true. They're going to borrow the money. They're going to send people the checks. But when people get the checks, they're not spending it. What they're doing, they're saving it. They're either paying down debt, which is equivalent to savings, or they're putting the money in the bank, which is savings. So certainly if you lost your job, you're not going to take your friends out to dinner. You're going to throw the money in the bank or pay the rent. But even if you didn't lose your job, you look around, like maybe your spouse lost his job. Maybe your neighbor lost his job. Maybe you think you're next. Like you have a job, but you're worried you're going to get fired next week. So you save it. And the name for that, economists call that precautionary savings, or, plain English, it's saving for a rainy day, except it's raining everywhere.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now let's continue.
So they are going to send the checks out, but people aren't going to spend it, and that's the reason you're not going to get the stimulative effect. But you are going to increase the deficit, which gets back to this debt to GDP ratio. So take the total debt divided by GDP, and that's some ratio. The research is very convincing, very clear. A number of studies show this, that up to about 90%, so 90% debt to GDP, you get a little bit of something called a Keynesian multiplier, meaning you borrow $1, you spend $1, and you get $1.10 of GDP, or you get $1.05 of GDP. And it works maybe temporarily, but it works when people won't spend the money the government can. That's the idea. But when the debt to GDP ratio goes above 90%, that's what physicists call a critical threshold or a phase transition. Now you're through the looking glass. Now the Keynesian multiplier drops below 1, meaning you borrow $1, you spend $1, but you only get 90 cents of GDP. But meanwhile, the debt went up $1. So what's happening to the debt to GDP ratio? This is going up dollar for dollar, but this is going up 90 cents on the dollar. So the ratio is getting worse. Guess what the U.S. debt to GDP ratio is today? The answer is it's about 135%. So we're way past that 90% threshold. And by the way, who's in that club? I can tell you, Lebanon, Greece, and Italy. So there's your lunch table for four, the four super debtors league. And it just gets worse. And that ratio past 90% is a headwind to growth, because people look at it and are like, hey, I don't have a PhD in economics, but I just don't like what I see. And people understand correctly. And this is the behavioral adaptation that policymakers on Wall Street do not understand. But the behavioral adaptation is people look at it and say, I don't know how this is going to end, but it's going to end. We're either going to have a default, or we're going to have something like hyperinflation to make the debt go away, or they're going to raise my taxes. Not sure which, maybe all of the above, but I have to save more money to meet my lifetime goals in the face of some bad outcome that's going to come out of this. That's the real world behavior. And economists know very little about the real world. So the point is, increasing the money supply doesn't work because velocity is declining. Increasing deficits doesn't work because people are saving, not spending, and they're preparing for worse outcomes. You can call it money printing or spending, but don't call it stimulus, because it doesn't stimulate. We're not getting out of this. And that's why I call my book The New Great Depression. I recommend investors buy physical gold bullion. It can be coins, bars. You need a safe place to put it. Don't put it in the bank, because there's a conditional correlation between the time you really want your gold and the time the banks are closed. So that's the worst place to put it. But you need a custodian or some arrangement that's safe to put your gold. Now, look, if you're a trader or a hedge fund, or you just want price exposure and for a short period of time, fine. Buy an ETF, buy a gold futures contract or whatever. But if you want to preserve wealth and participate positively in what could be some very bad outcomes, you want the physical bullion. But just to be clear, I recommend 10%. People always want to put words in your mouth. They go, Jim Rickards says sell everything and buy gold. I never said that. I think it's a really bad idea. My recommendation would be buy up to 10%. That's enough. So if I'm right, and obviously I think I am right, I wouldn't be saying this, but if I'm right about gold going to $10,000 or $15,000 an ounce in the next several years, you're going to make so much money, even on a 10% allocation, that's basically going to insulate the rest of your portfolio. If I'm wrong, which I don't think I am, but you're not going to get hurt too badly with a 10% allocation. So that's the right amount. And there's room for equities, but I also recommend a big slug of cash, because people go, well, cash has no yield. I was like, well, okay, but we could be in for deflation, not inflation. And in deflation, cash can actually be your best performing asset, because the real value is going up. Your purchasing power is going up. So it makes it a winner and also reduces portfolio volatility. And finally, cash has embedded optionality. If you're the person with cash, visibility is not great right now. I do forecasting all day long, but I would say that there's a very high degree of uncertainty. That'll become more clear with the passage of time. So if you're the person with cash, as you get visibility, you can pivot. Maybe you want to buy more gold. Maybe you say, hey, it's all good. Let's buy some stocks. Maybe it's time to buy private equity. But you have those choices. But if you put all your bets down now, it can be very difficult to get out of them if you change your mind. Henry Kravis runs a good private equity fund, but don't try getting your money back early from Henry Kravis, not before 7 years. So cash gives you that optionality that lets you be the buyer when everyone else is selling, for example. And treasury notes will do well because interest rates are going to go lower. So a slice of equities, a slice of treasury notes, big slice of cash, 10% gold. And there's room for some residential real estate, not commercial real estate. That has not hit bottom, but residential real estate in certain cities should do well.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.